Remember, we've been talking about consumer durables and the growth thereof, and how the next few months, because of the heat as well, maybe some of the cooler companies, etc., could well do okay. The other side of this story is what happens to some of the financiers as well, because that's that big growth area. It's not, there is a particular brand of consumer durables which could do well, but there are only a handful of financiers which are financing these, and therefore the question is just that. One, whether the lower borrowing costs for NBFCs for RBI policy will be a reality, whether that will help these companies in financing not just consumer durables but otherwise as well. And UBS has come out with a report on Capital First. They believe the management aiming to double AUM by FY19 is a positive. So let's get in the management. Vaidyanathan, CMD of Capital First, joins us right now in our studios. Good having you, Vaidya. Thanks so much for joining in. First things, do you believe over the course of the next 9 months, borrowing costs for NBFCs by and large, and for you in particular, will come off as well?
I'm pretty certain the next 3 months itself, there should be a reduction of about 25 basis points. Notwithstanding all the bankers' comments on the show that it's going to take time and all that, I think very soon at least 1 or 2 banks will drop the rate, then the competitive pressures will pick up. And I think it's a matter of time. As far as the NCD market is concerned, the debenture market is concerned, the CP market is concerned, it's already come down. I got some numbers for you. The 3-month CP rate has come down for a AAA company, has come down to 7.76% as of yesterday. Mm-hmm. So, and on the NCD market, already down by 30 basis points in the last 3 months. So my view, rates are already getting passed on, if not through the banking system, through the alternative banking system with the mutual fund market.
Okay.
Rates have been coming down both structurally and cyclically. And from the top, rates are down by about 150 pips, approximately, plus minus 10, 15 pips here or there. That has not led to a huge demand uptick. The basic conventional wisdom is that rates will come down, demand will go up. That's not happening in this cycle.
I think it will definitely happen. It will happen with a lag, because as the installments and the rates come down, the governors argued that there is 50 bips more to go, even in the past rate cut already, and another 25 bips yesterday. So in a way, he's making a case that another 75 basis points of lending rates have to come down over the next 6 to 9 months to 1 year. That's the case he's making. Now, as and when the last cuts have happened, that's a substantial savings of cash, about 400 or 500 rupees per household in India has already cut down. So that will translate to more cash in people's pockets, and will also result in more purchase of consumer durable items. I do believe that, for example, the 7th pay commission, that's 10,000 crores. So all that will come as cash in the system. It's a matter of time. It comes with a lag. But I do believe that this will be the year in which the consumption will start picking up again.
That's the retail loan market that you're talking about. What about the commercial loan market? What about expansion plans for projects? Because the fact is that companies are still going through the deleveraging cycle. We keep reporting that, either via the equity route or through, selling non-core assets, they're trying to bring down debt. Do you think that for the interim, there would be perhaps a lot of restructuring, so repricing of existing loans happening in this transmission process, then additional loan demand coming in?
See, the fundamental issue is that during the phase of 2009, 10, 11, 12, and even before, substantial of capacity has got created, which is still getting consumed through the increased demand, but not fully consumed. But you see the amount of investments happening on roads, ports, defense, railways. We heard the number, right? 2 lakh crores of investment happening through railways and through defense. So on roads, 59,000 crores on urban roads, 29,000 crores to rural roads. Now that's big cash. So that will eventually seep to the system. So I think I have no doubt in my mind that if you take a fast forward of 1 year from now, you will actually begin to see demand begin to pick up again.
So structurally and cyclically, things are looking up, and if
looking
you
very
put
good.
These pieces together, it will be radically different.
Yes, and eventually this will translate to financing for small entrepreneurs, because it starts with lending to the big guys, but after that, money just trickles down to these smaller entrepreneurs. So I do believe that we've talked enough and waited for maybe a year and a half, 2 years after the new government has taken over. I believe it's 1 year around the corner, and with that patience, it will happen.
Okay, I'm going to shift focus and take a 180-degree turn, talk about the other end, which is the consumer end, the consumer durable market, the fact that pay commission impetus will be visible going forward, defense impetus will be visible going forward now. How do you think things will shape up in the consumer durable market, in the consumption market now?
See, consumption is a natural pullback when any economy pulls back. End of the day, remember, we're growing at 7.5%. End of the day, jobs are still growing in the country. They're not exactly going down. So that will all lead to consumption. The consumer durable market, close to about 45% is financed by banks. So banks have a very natural advantage in financing consumer durables because they all have a credit card platform. And on the card platform, not only are they selling a durable, they're also selling a restaurant bill, they're also selling tickets, they're also selling airlines, and they have a single consolidated bill which they're sending to the customer. So they have a bit of a natural advantage. But the installment-based loans, therefore, is a very NBFC-specific market, only 15% of the durable finance market, but a growing market. For example, this year we expect the durable financing through EMIs to grow by anywhere about 40 to 50%, and that's still big growth.
Why can't banks come in there?
Because banks have a very natural advantage already. Because if you're a bank, I'm not sure you'll set up a installment-based loan when you already have a platform in the form of a credit card. So if you have a credit card, you can go to a merchant establishment, you can buy the TV or fridge you wanted, and you could walk away and get an installment on the card. So if you're a bank, that's a natural low-cost platform. If you're an NBFC, you don't have a card, then this is an installment-based, EMI-based, PDC-based, ECS-based, more expensive model. But I guess they can
a lot
still
of consumers are buying online now, and when you go on a Flipkart or Amazon, if you're buying a white good, a heavy duty item, 50,000, a lakh of rupees, you can actually take an EMI there on the website when you're purchasing it. So is that a lot of business for you?
That's a big business again. It's of course a big business and it's a growing business. But since credit cards is largely a bank platform, it's still happening out of there. As I said, the installment EMI-based platform is 15% of the overall market. That's 15%. It can still grow. We believe it's set for big growth in the years to come. But that's 15%. Just putting it in perspective.
How much value does that bring to your business? I mean, it seems like more like a volume play,
yes,
because it's a small ticket business.
Yes,
right?
it's a tough business. The typical installment, typical loan is as low as about 25 to 30,000 rupees. The typical installment is about 2,500 rupees. And to collect on a 2,500 rupee EMI in a far-flung location can be quite difficult. But no doubt, despite the difficulty, I do say it's a business opportunity. Our numbers, for example, for durable financing is about 1,500 crore loan book is what we have. We expect this can grow about maybe 40 or 50% next year.
So, coupled with that, the UBS report says that your overall AUM could double in the next 3 years. Is that a reasonable estimate, or would you believe it's conservative?
We have been growing, as you know, last few years quite well.
Yes.
For us to grow at about 25% compounded 3 years from now, if that results in a doubling, so be it. But I think that's the sort of, because the next 2-3 years looks really, really good. For us.
Why are next 2-3 years looking really, really good?
They're looking really good because the customers we're financing is small entrepreneurs, and these are shopkeepers and the merchants and so on. That market is growing. You see, we are often getting very colored by the high NPA numbers of the large corporates and stake sale and deleveraging. These are actually grabbing our attention. But at consumption level, SME credit at a services level. Let's not talk manufacturing. Even manufacturing is growing. But services level, SME business is growing very well.
Okay, closing comments. If I look back, if there has been one big pocket of consistent growth, that has been the housing market. It has grown irrespective of the economic terrain we are in. So if you have to pinpoint, let's say, one more pocket where for next 5 or 6 years, you're confident of a 15 to 20% growth, not for your firm, but across the board in terms of a category, which will be that category?
Definitely housing.
Still housing?
Definitely housing.
Okay.
Because one is, of course, the government is now pushing for housing for all. Okay. Now, whether we achieve housing for all by 2022 or not, at least it's a laudable goal, and the government is putting all eggs behind it. Now, basically, at least at Capital First, we don't finance salaried people wanting to take a home loan. You might as well go to a big bank like ICICI Bank or HDFC.
I should not come to you.
Don't come to us. Right? Don't come to us. But if you're a trader, you're a shopkeeper, and you're happy paying a 12% rate of interest, but you want a housing loan, then we are the entity for you.
A lot of our viewers are also traders.
Yeah, sure.
Stock traders, but will you finance them?
I just thought of that.
No, undoubtedly. And that's really a fantastic opportunity. And we think that, because the salaried guy gets financing from anybody. It's the self-employed guy, the small trader, he doesn't get financing, and that's our business.
That's true. A lot of these self-employed people, and we have BPCL, so we'll just go to the management in a bit, but I think this is a pertinent point. A lot of self-employed people say, hey, we don't get credit cards, we don't get loans from banks. So I think maybe NBFCs like Capital First are like that. Great. Vaidya, thank you so much for joining in. Congratulations on winning that Entrepreneur of the Year award as well.
Thank you very much.
Thanks for being with us today.
30 seconds of ad time for you. I'm going to charging you today.
Thank you. Thank you very much. I appreciate it. And all people at Capital First will be very happy with that. Thank you.
Thanks for joining in today. Okay, from consumer durable financing and a very confident management of Capital First to management of BPCL, the first interaction post this new crude import policy for oil marketing companies. And the management, Mr. P. Balasubramaniam, Director of Finance of BPCL, on the line with us. Good having you, sir. Thank you so much for joining in. Now, Mr. Balasubramaniam.